They call it a rally, a bounce, a rebound, whatever you want to call it. They all fit today's action. All three major averages roared higher today. The S&P with its best day since early May. All 11 sectors in the green today, led by energy. The Nasdaq up around 2.5%. The Dow finishing the session up close to 650 points. Check out the gains in United Healthcare. It alone accounted for about 190 points on the Dow. Do you buy this rally, Guy? Do we see the worst of it?
I think in the short term, absolutely. You know, I thought the panic was on Thursday. Friday was sort of sideways. Today makes sense. I think the market can rally for the next couple weeks, quite frankly, 8-9%. But then I think you're selling it again. I think this rally is going to provide you with the opportunity to make sales and then look for a subsequent move down to probably, I don't know, 3,400. And I'll give you one more little tidbit, because why not? It may come in the form of Apple earnings, not necessarily the quarter, but potentially their guide. And if Apple guide suggests like what I think is going on, and Katie Huberty from Morgan Stanley has been cautious. She hasn't been that way in quite some time. I think that's what takes the market the next leg lower.
Yeah, we are in this little, I don't want to say honeymoon period, but information vacuum maybe is a better term for it ahead of earnings season, Karen.
Yeah, I mean, we're just back to where we were Thursday at lunch. So it felt like a big rally, but, you know, and I've been positioned for a little bounce, but mostly long. So it's been, you know, a dreadful, dreadful month. But I think we maybe have a little more room to run. I agree with Guy. I don't know if it's going to happen tomorrow or not, but I still think there's a little more, there's room above for some relief rally to continue.
Would you use these rallies to sell?
Yeah, look, the 21.5% move in 50 sessions from April 1 down in the S&P left you in a place where stuff's very oversold. We've digested also, think about what we digested last week in terms of the move and the yield curve, but mostly just rates outright. And so I think you've had three rallies, certainly two decided rallies of north of 9% in the S&P since January. This is an opportunity, especially if you can get some sense from a couple of the data points on inflation. And that would really be, I think, the catalyst to giving you more of that trading range. But would agree, you know, somewhere up to around 4,200, I think we have some room. I think down to 3,800 and change, we've certainly been testing that. I actually think the next level is 35.
Yeah, I'll just say this, quarter to date, I mean, it's got to be one of the worst quarters we've had in the market. The S&P is down nearly 17%. Obviously, that's including today's gains here. And, you know, could we rally into quarter end before, like you're calling it, an information vacuum? It's not too dissimilar than what we saw in the second half of March. There was this kind of lead up into that first Fed increase that we've seen in many years, and then we just rallied on the way out of it. But to Guy's point, I don't think the news gets better as we get into July, because I really do think the focus is going to be on that E coming down. And then investors are really going to start to say, okay, well, we overshot on the multiple to the upside. We're probably likely to do it near term in the downside.
For more on where the markets could be headed next and where to find opportunity, let's bring in Katie Stockton, founder of Fairlead Strategies. Katie, great to see you.
You too.
So what are the next levels to watch in the S&P?
Well, we have one level that's in play, and we've been watching it for a long time. It's around 38.15. It's based on a Fibonacci retracement, and it has been penetrated pretty decisively, and that leaves a breakdown pending confirmation in our work this Friday. So if we do see that breakdown, unfortunately, the targeted support level, also derived from a Fibonacci, becomes about 3,200. There is interim support around 3,500. That's obviously a very widely followed level and would be a natural place for some kind of relief rally. And as you mentioned, it does seem like there's some kind of relief rally underway, but we don't think it's really tradable. We are using it in part to perhaps cover some short positions with the possibility of additional stabilization, but we think it will be somewhat short-lived and very difficult to trade, really similar to what we've seen already year to date in terms of these counter trend moves.
So let's say we are on a path to that lower level that you had outlined, Katie. What does the other side of it look like? I mean, we just had a strategist at the top of the show. I don't want to pit you guys against each other, but from the viewer standpoint, you know, you're hearing a strategist say 4,700. What do you see in the charts?
Well, to me, I think September, October would be a very natural sort of timeline for a major bottom. I don't know if it'll be the bottom or just a major bottom, but the way the indicator's set up, and it really is just based on technical analysis, nothing macro is being incorporated here. But the way the indicator's set up is that we should have some kind of reaction to the long-term oversold condition by then. And what we're watching in particular is the high growth arena. as measured by benchmarks or ETFs like ARKK as one, those areas of the market are extremely oversold from a long-term perspective. So we're watching for some kind of basing phase to develop there. And by that, we're not adding exposure in anticipation of it, but looking for more stabilization, sort of sideways to lower price action. And as that happens, we would expect momentum to improve sort of under the surface. And that's where confidence would be restored, in our opinion, enough to get the market out of this bear market cycle. So we're watching for basing phases to develop in the most oversold areas of the market as really a precursor to that kind of big major low.
Do we need to see big cap technology go down more in order for this overall basing to happen?
I would think that we'll see downside leadership on the next downdraft yet again from the mega cap complex on the technology front. So if you took a technology spider or XLK and you compare it to the S&P 500, it's been trending lower year to date. That's with underperformance, from the likes of Microsoft and Google and even Apple more recently. So we're looking for more of the same in terms of downside leadership there. And it's hard to picture the major indices weathering that very well, as you can imagine. So based on the indicators alone on their long-term charts, so looking at their monthly bar charts, they have a little bit more room than the higher growth arena in terms of downside to oversold territory.
All right. Katie, great to see you. Thank you.
You too, of course.
Katie Stockton of Fairlead. Guy, more downside. I mean, Chris Verone just on Friday was saying 100 for Apple.
Well, 100, I mean, if Apple were to trade 100, that would, to me, if doing the back of the envelope math, it gets you an S&P somewhere between 3,100 and Tim's 3,200. So that would be, I think, catastrophic. I mean, I don't think anybody thinks Apple, well, I shouldn't say that. I think people would dreaming they could buy Apple that low. I don't think it gets there. Tim has mentioned 115 a number of times. And I got to tell you, into their July 26th, I believe that's on the report release, that starts to make a lot of sense given the backdrop. So I'll say again, I think the market can rally from here another 8 or 9%. I think that's where you're taking money off the table and you're looking for that flush into Apple earnings at the end of July.
Yeah. Dan?
Yeah, so if you look at the pre-pandemic high in February 2020, the S&P 500, it was about 3,400. And if you want to use the 10-year average multiple, the S&P 500 about 17 times, you could say that in a bear market, in a recession, that should be lower. But let's just use the 10-year average. And you want to say that earnings growth at high single digits for the S&P 500 for this year are still too high. We all agree on that. We've all been talking about that. And let's just say they're flat. Okay, worst case scenario, maybe that's $200 times 17 gets you to 3,400. That's when I would start thinking down 30%. Round tripping the entire move. That's how you have to think about bear markets. It's like, just like we all knew things were getting a little too overzealous late last year, early into this year, you're not going to know. It's going to have to feel really bad before you say, all right, we're probably over. Down 30% in the S&P 500, retracing all all of that is probably at a place where you start to feel like things are really bad.
That's a big earnings revision downward, though, for the straight consensus to 200.
So I totally agree with getting back
after the fact, though, just to be fair.
Getting back to pre-pandemic levels on a lot of different stuff. And you have to remember that the S&P did 15% from October of 2019 into that pre-pandemic high somewhere around Feb 2020. So again, it was a market that rallied heavily into the pandemic, crashed. And so using that high point, I think might even be generous if you're actually trying to figure out where things should move to.